welcome to our workshop introduction to venture capital. So moving on to the next slide.
Bro, I didn't know we put animations. All right. So just before we get into the in-depth of the workshop, we're gonna talk a little bit about security. So if anyone doesn't know what a security is, it's basically a financial instrument or a financial contract and involves like having a claim on the security issuer's future income or assets. And there are three main types of securities. There are debt securities, equity securities, and then there are the other hybrid, other kind of securities. Um, yeah, they're literally called like other or hybrid, so you can search them up. But in terms of debt securities, these are what you hear about as like bonds. So you issue debt, and that's what bonds are basically. They're also equity securities, where stocks. So shares of a company, think like you can buy into shares of a company. That's basically what equity securities are. And then derivatives are just some examples of like these hybrid ones, which are futures and options. So before we get into too much about venture capital, I want to talk a little bit about buy side versus sell side. So in finance, there are these two different sides. You have buy side and you have sell side. So what sell side is this is where most firms provide research opinions on different companies, different securities, essentially. And if you've ever gone on, I don't know, TD Ameritrade, just Market Watch, Seeking Alpha, Fidelity, just any kind of research thing, you hear companies, or even in an equity research report, you see talking about like estimates or consensus estimates. This is where it comes from. A consensus estimate is basically all these researchers coming together and saying, hey, this is what everyone predicts it's about to be. This is the consensus here. And these are just some examples of different types of firms on the sell side. So you have your typical investment banks, commercial banks, stockbrokers. Um, yeah. So then um, you also have a buy side, which is what is involved in actually purchasing the investments. So this is where usually you have a lot of the money. This is where the big money is. This is what you would consider like the rich people. So you know what happened with GME. It's a hedge fund. Hedge funds got squeezed. They got screwed over. They have all that money and they made a bet and they got screwed. Their bet was wrong. This is like that's where all the money is. Other firms on the buy side consist of asset management firms, private equity firms. You also have kind of like growth equity and just other institutional and retail investors on the buy side as well. So that's kind of a little brief introduction between the difference between buy side and sell side.
So moving on to what exactly venture capital is, it's a type of financing that investors provide to early stage or startup companies and small businesses that are believed to have long-term growth potential. It's usually focused in on companies that have been made for about 3 or less years, early stage, potential for high growth and high return.
And then within a venture capital, this is kind of like the structure. So you have LP and GPs, limited partner versus general partners. And limited partner is basically the high net worth individuals that invest their net worth into the VC. The general partner is usually the professionals or the analysts or whatever within the actual VC that go around, search for ventures to invest in, and usually they end up taking a board seat at the firm after the investment. And there are many different ways that VCs find investment opportunities. One of the main ones is demo days. This is essentially where a bunch of startups gather. You have a lot of institutional investors, there's companies all looking, gathered around people with a lot of money. This is the people you want to impress. This is the people you want to fund. Um, Relaying it back to our prompt, this is kind of, you're in the situation of like essentially a demo day. You're the company there and you're trying to impress people and get them to give you money, basically. Yeah, and then other forms of ways that VCs can find investment opportunities, just they have applications where you apply or you just network. Networking is so important, especially within um, just in general, networking is so important, especially in the Valley where tech companies, it's, everyone knows everyone. And, you get a bad rep here, you're screwed. So network. This is why we say use LinkedIn. So join our LinkedIn group. Yeah. And then when VCs look at a company they want to invest in, there are three main components they really value. One is the technology, two is the team, and the third one is the product market fit. First one is the technology. So what exactly are you selling? Like, is your technology strong? Is it like, is it something viable? Is it actually like a product? Like, or are you just selling some like, I don't know, some crappy thing that's probably not even going to work? Second one is the team. This one is a lot more on the founders, on the board of directors right now. You look at the company, you look at the current CEO, you look at who's running the company. Are they, do they have a vision? Are they strong? Are they capable individuals? Like, do they look like they're going to waste your time and waste your money, or do they look like they actually have like a future? Yeah, so a lot of that is also looking at what they've done in the past. Like, hey, have they successfully started business ventures before, or are they just consistent failures? you know, that kind of stuff. And the third thing is the product market fit. So this one is a lot more like what your product is doing. So is your product entering a, let's say, 200 billion market cap? Like, is your product going to go into a market that is already very diluted and very competitive? If you're going to go into, like, let's say, I don't know, like computers, well, you have Apple dominating the market. It's probably a many billion, hundreds of billions, if not trillions dollar market. So going into that market is probably not a good idea. However, if you want to go into a smaller market, you like maybe like 100 million, $200 million market, that's a lot more competitive. You can be successful in it. So it's looking how your product will fit in the current market. Um, one thing I'm one thing I remember hearing about from a Stanford lecture was you want to have like 10% in a you don't want to have 10% in like $100 billion market share, but you'd rather have like 1% in like 100 million or something like that. I don't know, something like that. But yeah.
And then moving on to the differences between venture capital and private equity, you might have heard of both of these terms. So they are both focused on private sector investments. So these are not publicly traded companies. You can't just, open up Robinhood and buy a share. These are usually kind of for the higher net worth individuals to be working at. But the difference is that venture capital focus on emerging companies, like I said earlier, early stage, early development. Private equity focus on more established, long life companies who have an inefficiency that they try to get a large ownership stake in. They fix the problem, then they kind of sell their return for it once it starts making profits. Venture capital is trying to get along for the ride before something like Uber takes off when it was growing, something like that. And also, you find that venture capital firms, because they typically are smaller than private equity firms, they are more industry focused. They try to be experts in one specific industry, maybe healthcare, maybe tech, software, something like that. Whereas private equity, they have a lot more money. They typically have between over $100 million in their investments that they make. Venture capital is usually between 10 million. So those are kind of the big differences between the two. And then going on to the actual venture capital process. So, step one is where the business must submit a proposal to his VC firm in order to request funding. This is kind of portrayed on Shark Tank. When they walk in, they give their pitch. That's what this is. You can do this in a demo day. However, if you aren't going to one of these events, you do have to submit a written report, and they require pretty much the context of what your market is for your product, kind of like what we're doing in the case comp. That's part of the rubric. And then financial protections, management of the company, and what your competitors look like. And then the second stage is that once the VC firm is interested, they like the sound of your product, they start doing their own research into your company, because for all they know, the report that you sent could be um, false. It could be unethical. You could be doing some malpractice through accounting reports or financial statements, something like that. So the VC firm isn't willing to take any business's word. They're going to make sure they do their own due diligence, their own research, and making sure that it's a good investment to make. And then the third step of the process is once DD is completed, the VC firm will pledge to make an investment of capital in exchange for an equity stake of the company. Pretty much now, they try to help the startup or the emerging business along to try to give them a boost in order for the VC firm to get a better return on their investment. And you might have also have heard this term as a Series A investment. It's called that because once this company goes public, the VC firm will get preferred shares known as Series A shares, and pretty much just a stock that is preferred to them. And then the fourth step is the VC firm will exit their investment, which is typically 4 to 6 years after their investment. This could be through a merger and acquisition or an IPO.
So yeah, when multiple VCs are competing to have an equity stake in one company, they'll usually every VC will have a term sheet. So basically, a term sheet is what outlines the terms and conditions of the potential business agreement between like the company and the actual VC. So these are just some of the basics of a term sheet, like what's included in one. And I'll go over some of them briefly and pretty quickly, but I'm not going to spend too much time on them. Pre and post money valuation. This is basically like, hey, if the company currently is like what worth $3 million, and the VC says, hey, I'll give you a loan of $1 million. Well, ideally, post valuation should be 4 million, but if you're adding in a VC and you're also giving them some kind of equity stake, ideally it would be more than $4 million. So it's added benefit, not just the cash. Liquidation preference. If the company fails, let's say the VC valuates the company at like $10 million, but instead it sells at 5 million, the VCs get their money first. Liquidation, they're preferred in the liquidation process. Board of directors, usually the VC gets a board seat. Protective provisions. This is protecting the VC from any kind of unnecessary or like large or risky spending from the actual company. Typically, this will mean that the board approval you'll need the board approval before actually spending any money. Right of first refusal. This is when a company is more diluted and they have more shares in the market. Let's say originally a VC has like a 20% stake in the company. Well, let's say that the company issues more shares, that 20% will start being diluted lower. So the VC will have the opportunity to purchase the shares first before it goes on the market where you and I can buy these shares. Pro rata is basically you're able to put in additional capital to maintain that current investment at X% if like the company shares does become diluted. Basically, kind of the same thing. Drag along. Lead investors are able to drag along like the angel investors. I'm gonna skip employee option pool, no shop agreement. So I'll get to your question in a second. So basically, a term sheet is non-binding. It's not like legally binding. However, but you do have to sign the term sheet. However, you don't have to follow through with it. But the thing is, if you don't follow through with it, your reputation becomes pretty trash. It goes down. But yeah, mainly this agreement, it restricts larger companies from soliciting competitive bids from like other different types of firms. Okay, Matthew, your question, does a preferred share refer to getting money first in the event of a liquidation? I'm not sure what you're asking. Chance, do you get?
For that, if your company does get liquidated and you do have a preferred share, yes, you would be more in line to get your money back. So preferred shares depends on the preferred share. Companies can issue out different ones, depending if it's Series A, B, whatever. But you can get something known as like a 1x preferred share, which means you will get your initial investment back and get a 2x, a 3x, or 2 times your initial investment. But yes, you would get that, and that would be paid out before a normal common shareholder. And then going over what is an IPO. So an IPO refers to process of offering shares of a private company into the NASDAQ or New York Stock Exchange, which is now allowing it to be public. Pretty much now you can buy it on Robinhood. You can lose, all your money. You can supposedly buy it on Robinhood if they let you. Controversial topic, but they said to let the people trade. They don't really fall through with that. But essentially, once an IPO goes through, that was what allows you and me to kind of purchase the stock, start investing for ourselves once kind of the big money has already gotten their big return out of it. And then just seeing a takeaway, VC popularity has grown immensely. It originated back in like World War II, and it's only spiked since then, especially since these firms are focusing on high growth. The whole kind of market more shifting towards technology companies has really allowed for VCs to get the return faster, and which has made them able to make more deals in a given year. And then the balance of venture capital investments is heavily skewed towards technology companies and healthcare companies, mainly because these are the kind of investments that get quick return. You think of something like an Uber, a Doordash, something like that, where the product picks up steam. These companies can burn revenue. They don't really have to focus on profit. It's all about growth. And that's what these VC firms like, because that's what's going to get their investment done faster. And then looking over an example of a VC funded company is Slack. So Slack raised about 1.4 billion through VC firms. They IPO'd about in April 2019. And then they were acquired by Salesforce in 2020. And for one VC firm, Excel, they had provided a $200 million stake, which had them at a 24% equity stake of 4.6 billion once the company was public. And now that has gone all the way up to 1.1 billion as a gain. So they made a gain of about $800 million, which is a pretty good return on your investment. And then one more, we're looking at Doordash. So Doordash raised about 2.485 billion through VC firms, such as SoftBank, Sequoia, and Singapore's GIC investment fund. They IPO'd in December 2020 for $102 a share. It spiked about 100 to 175 that same day. And the average value of the shares that were purchased by the venture capital firms was about $8.73. So per share, they made about $172, which is pretty good considering it's only been on the market for about a year. So all those firms made a massive return.
So, I think I skipped a slide. All right. So when you look at when VCs look at companies, they have to have a way to evaluate these companies. Those of you very interested in like finance-focused fields, you're going to hear a lot about these next two topics I'm going to talk about. It's going to be the company comparable analysis and a discounted cash flows, DCF. So if you're triggered by hearing the words DCF, don't worry, I do too. It took me forever to figure out what a DCF was. Yeah. But in terms of company comparable analysis, you're essentially looking at different comparables, like different comps, and essentially putting them together. In this case, I did a report between FedEx, UPS, JB Hunt, and DBHL, or DHL. So these were some of the ones I put together, and you just kind of create a report or an analysis to kind of see like what company and how you would value them. Specifically, you'd probably want to look at EV, enterprise value. That's a huge one to value companies. Yeah. And then another valuation technique is the DCF. So a DCF is basically estimating the company's intrinsic value, which is essentially estimating what a company's ability to generate cash is, because that's what a company does, generates cash. So if a company generates cash, it's probably worth a lot. That's essentially what a DCF is. So what you would do first is, it's not showing here, but this is more the this actually shows. Okay, so what you would do first is you would build a forecast. Those of you that were here for last quarter, forecasting in finance, essentially what you would do here, you would build a forecast, and then after that you would take the forecast and you would use the numbers that you get, and essentially up here you can see where we have the EBITDA, EBIT, tax rates, and all of these numbers up here where you just get them from the forecast. Now, once you have that, you would essentially calculate the terminal value, and That's basically the present value of all your business cash flows at a future point, assuming you have like a stable growth rate. Yeah. And then afterwards, you would discount the cash flows in order to finally get the present value. And yeah, that's kind of what that's basically a DCF is. So what was the purpose of previous report you did and comparing valuation? So these are basically just different valuation techniques because no one valuation technique would work. Let's say you have a company, like a technology company. Um, Most technology companies are not profitable at the start. They're creating technologies to be more profitable in the future. So discount cash flows would not work for a lot of more tech-based companies because their profits would be coming more in the future. So you have to find a different way to evaluate those companies. So a DCF would probably not work for tech-based companies. These are just different ways of evaluating companies and kind of analyzing them. Did I answer the question, Kelsey?
Um, sort of. I think that was valuable, but I was just curious on what your actual like use case was for the report you were making, just so I could understand why
Yeah.
you were doing the valuation.
So for this one, I was evaluating FedEx and trying to see like if they were a buy or not a buy, and what exactly I would evaluate their price as, given the equity research I've done for the current company FedEx. And then I would also compare it to like the current market. So you have to look at their competitors and see how their competitors are doing, looking at their PE ratio, EV/EBITDA, and you can see how some of them are pretty similar. However, their PE is kind of low in FedEx. So you just kind of look at these valuation metrics and you get to see if these are like vastly different from one another. You might get a little sus, but this kind of really you see the overview of like the market and what the different companies are that are in that market. Also just a different valuation analysis. Okay, and then so all these numbers here from that I got from both the DCF and the company comparable analysis, you can find them on the SEC. So you can, I would recommend going to their 10Ks or 10Qs and just searching them up. So to get there, you would go to sec.gov, you'd go to the company filings at the top right. And then within here, you would put in the ticker of the company that you would want. So Apple is AAPL, I'm pretty sure. Yeah. And then Microsoft is something like MSFT. So if just put the company ticker that you want in here, and then you would you'd bring up to this screen, and then you would search for the 10K. So you can see that there's some of their 10Qs are currently up on the screen and their 8Ks. However, if you want like a yearly, so 10Qs and 8Ks, those are quarterly. 10Ks are yearly. So you would go find the 10K for the yearly report, and then yeah, that's their 10K. And you would find all those financial items that I mentioned earlier, like EBIT, EBITDA, just general revenues and earnings, cost of goods sold, whatever. If you took MGT 11A, you know exactly what I'm talking about. Yeah, you can find all those in section 8, which is the financial statements and supplementary data. Yeah.
And then just to answer your question, Nicholas, so DCF just doesn't work if you're discounting cash flows, just because for some companies, right, let's say a healthcare company, they're getting a trial run through a certain medication, hasn't been on the market yet, but it cures osteoporosis or something like that, right? Something crazy. That's going to make the valuation of the company go crazy just because the potential for that will be very vast. So when the company isn't generating a lot of cash, DCF might not work. DCF is usually always effective. It just has its own kind of place to use it at. But for more companies that are more traditional, the same kind of revenue streams kind of grow that like that, then DCF would work very well. And then market cap is just multiplying the price of your share times the amount of shares you have issued. So that's what market cap is. So market cap as a general way to evaluate your company isn't very good. So I would definitely not use that to, in your case comp, say, for, you can talk about what your size and your market cap is in your like competitive scenario, but don't use that as your kind of like valuation technique or anything like that. It's good to highlight your area in like the blue ocean scenario you're talking about, but just make sure when you're talking about, we value our company like this because of our market cap. That's not really a one-to-one. You probably want to look at more like enterprise value or something else Kevin had. And also this slideshow will be given to you so you can kind of go take a closer look if you want.